Hello, and welcome. In this video, we'll walk through a 2-day tactical outlook for gold, that's XAUUSD, covering where the metal is likely to trade between June 2nd and June 3rd, 2026. Let's get into it. First, the snapshot. Gold is trading around $4,527, up nearly 1%, about plus 0.97% on the day. That's a gain of roughly $43, inside a session range of $4,463 to $4,542, against a previous close near $4,485. This recovery puts gold back at the top edge of the May $4,450 to $4,500 range. But it remains about 19% below the all-time high of $5,589, set on January 28. The 2-day verdict is neutral, with a two-way tail, and 4,500 is the fulcrum. So what's the story behind the move? Gold rebounded just under 1% to about 4,527, recovering Monday's nearly 2% drop, and climbing back to the top of the May range. The macro backdrop is still a headwind, a firm dollar, a roughly 4.5% 10-year yield, and a near-certain June Fed hold. But the US-Iran and Strait of Hormuz situation has flipped back toward re-escalation. The deal is unsigned and contested, Iran has reportedly frozen talks, and oil has jumped 4 to 5%. That restores a real safe haven upside tail. Because this 2-day window carries only second-tier data, the live driver is the Iran and oil headline, not the economic calendar. 4,500 is the fulcrum. Here's the macro dashboard at a glance. The US dollar index sits around 99.15, a firm headwind. The 10-year Treasury yield is near 4.48%, in a range of about 4.46 to 4.51, and rising. The June 17 Fed meeting is almost certain to be a hold, around 99.4% priced, at 3.5 to 3.75%. And Brent crude is up about 4% to roughly $95, with WTI near 92. So the dollar and yields keep gold's opportunity cost high, but rising oil signals the geopolitical premium is rebuilding. Now, what's pushing gold each way? There are three forces. First, the dollar and yields, a clear headwind, scoring 3-0. A high opportunity cost, a June hold almost fully priced, and sticky inflation that cements a higher-for-longer stance. Second, geopolitics, which is two-way and reheating. There's no signed deal, Iran disputes the terms and reportedly suspended talks after strikes in Lebanon, even floating a closure of the Strait of Hormuz, and Brent jumped to about $95. A breakdown there is the cleanest bullish surprise, a signed deal unwinds the premium. Third, central bank flows, a structural bid, also 3-0. Central banks bought about 244 tons in the first quarter, up 17%, with full-year guidance of 700 to 900 tons. That's the floor under gold, though ETF demand is decelerating. Let's look at the catalyst timeline. On Tuesday, June 2nd, JOLTS job openings give the first in-window read on labor demand, two-sided. On Wednesday, June 3rd, ADP payrolls, the S&P PMIs, and ISM services land together, an NFP pre-read plus a look at services momentum and prices paid. Friday, June 5th is the star event, the May non-farm payrolls, with consensus around 100,000 jobs and 4.3% unemployment. A soft print is bullish for gold, a hot one bearish. But note, that's just outside the 2-day window. On Saturday, June 6th, the Fed communications blackout begins, silencing Fed speakers into June 17th, so data and headlines take over. Running throughout is the US-Iran and Hormuz situation, where escalation is bullish. And further out, May CPI around June 10th, then the FOMC and dot plot on the 17th, both past this window, where a hot or hawkish surprise is bearish. Now the technical level ladder. To the upside, resistance starts at 4,615, then 4,620, which is the 4-hour 200 SMA, and 4,655. Reclaiming that band reopens the upside. The pivot, the line in the sand, is 4,500, with price now around 4,527, just above it. To the downside, support sits at 4,400, the 50 EMA, then 4,366, and the channel floor at 4,320. The picture is neutral to bearish on the 4-hour chart, a descending channel with RSI near 49, but constructive on the daily, where price holds above the roughly 4,411 200-day moving average. So how could the next 2 days play out? 3 scenarios. The base case, at 50%, is range or chop, gold staying between 4,460 and 4,545 around the pivot, with inline data and Iran headlines that simmer without resolution. The bull case, at 30%, is a safe haven bid that reclaims 4,500 and pushes toward 4,615 and 4,655, driven by Iran-Hormuz re-escalation and extending oil, or soft data. The bear case, at 20%, is the headwind winning, losing 4,500 down to 4,400 and 4,320, if the deal gets signed and data comes in hot with a firmer dollar. Remember, these probabilities are analyst synthesis, not verified data. Here's the bottom line for a trader over these 2 days. It's neutral and two-way, so trade around the 4,500 fulcrum and let the headline and the level set direction. Sell rallies into 4,615 to 4,655, invalidating on a daily close above about 4,660. Buy dips only on a confirmed hold or reclaim of 4,500, with a stop below 4,463, and a higher conviction dip buy at 4,400. Trade the break on confirmation, long above 4,500, short on a decisive loss of it. And watch oil as the tell, an escalation headline can spike gold through resistance intraday, so keep size modest ahead of Friday's payrolls. Finally, confidence and the open gaps. We're highly confident on the spot price, the near-certain June hold, the central bank demand story, and the 4-hour technical red. The open gaps are the live intraday price for June 2nd and 3rd, the actual JOLTS, ADP, and ISM outcomes versus consensus, whether the deal gets signed within the window, and the verifiable current positioning data. And one important reminder, this is not financial advice. Over a 2-day horizon, gold is acutely headline-driven, a single Iran or Hormuz surprise can flip the bias intraday. Always use stops and size to your own risk tolerance. Thanks for watching, and trade safely.